Hey everyone, welcome back to the Weekend Charts. I'm your host, Charlie Bilello, and as always, I'm going to take you on a tour of markets and run through the most interesting charts and themes that are going on today. And by far, the most interesting thing going on today is the fact that the equity market's doing what nobody predicted it to do, which is pretty much having an unbelievable start to the year. So, if we look at sentiment entering the year, we look at the end of 2022, we look at Wall Street strategists who love to make these predictions each and every year of where the stock market is going to end the year. They're almost always wrong, but they still make these predictions anyway. And they're often saying the stock market's going to go up. And why do they say that? Well, they're playing the odds. The S&P 500 historically has been up 3 out of every 4 years in terms of calendar year. So why should you ever say that it's not going to go up? But interestingly, going into 2023, that's exactly what they said. This Bloomberg had this piece last year. I talked about it last year, but this is the first time in decades that these strategists were predicting stocks to go down on the year. And what have we seen so far this year? Well, the complete opposite. S&P 500 is off to its best start to a year since 1997. So you have to go back a pretty long time to see a better year at this point. We're 114 trading days in. S&P's up over 15% on the year. Now, is this predictive of anything for the back half of the year? Not at all. I wouldn't use this to say anything, but it just shows you how negative sentiment was entering the year and how nobody really envisioned the S&P 500 doing what it's doing today. And this is a pretty substantial rally off of the October lows now. It's getting harder and harder to dismiss it. There's more people saying this is a new bull market now. I don't like those terms at all, bull or bear, not really helpful. It would have been helpful to say back here at the October lows that was the start of a new bull market. Then that's helpful if you're buying in at that point. But here we are, 27% higher. People saying it's a new bull market. We're at the highest levels since last April. And if we look at the S&P 500 index now, it's only around 8% below its January 2022 peak. So not that far off. That's on a price basis. On a total return basis, it's within 5 or 6% below. So if you include dividends, so not that far off from hitting a new all-time high. And if we look at certain sectors, and the biggest sector by far is the tech sector, they have already recovered and they're at new all-time highs. So this week, the S&P Tech Sector ETF XLK, look at total return, so including dividends, it hit a new all-time high. So recovering from that 34% decline last year off of that December 2021 peak, huge rally, 50% rally to a new all-time high. So pretty incredible here. And what a difference from the March 2000 peak, which a lot of people are comparing this to in terms of tech valuation and sentiment. Back then, there was an 82% decline and no new all-time high until March 2017. It took almost 17 years for the tech sector to recover. So what's driving this today? Well, mega caps, Apple, Microsoft are a huge part of this index. Also have Nvidia, obviously, and these stocks are leading the entire market higher, as we talked about many times. So what is going on with sentiment today? Well, people are feeling a lot better than they were. And what's driving that? Well, really, it's coming down to these four factors that were driving sentiment lower last year. So the reversal of these factors has been a huge thing, a huge weight off of the equity market. And if we look at inflation trending lower, 4%, we'll talk about that in a little bit, but people feeling much better about inflation and their expectations for inflation going forward. The Fed, we'll talk about that as well. Fed finally pausing interest rates, so people are not as fearful in terms of the Fed continuing its tightening from here. If we look at the recession, huge one here. Everybody focused on recession at the end of last year. We called it the most anticipated recession in history. When I polled people, most people said we were either in or going to be in a recession in 2023, and here we are, almost halfway through, and fewer people are saying that. And mostly that's due to the continued strength in the labor market. And then we have the Russia-Ukraine war, which was a big negative factor last year, particularly in terms of inflation, but really the tail risk as well. And you're just hearing less about it. It seems to be less of a concern for people, at least right now. So you have these big four factors all weighing on the market in 2022 and showing opposite in 2023, people feeling better about all four of them, it seems. So perhaps no surprise, but equity markets are rallying and people are getting more bullish. And that almost always happens. But here we are now with 22% more bulls than bears in the AAII sentiment poll. So polling individual investors asking, what do you think about the S&P 500 over the next 6 months? And now all of a sudden, everyone's bullish again. And I wouldn't say extreme just yet, but we're getting closer to some type of extreme kind of level on the opposite side. So last October and September, every week I would talk about how sentiment was extreme on the downside. So bears were outnumbering bulls at the October low by around 36%. So a huge spread that was one of the widest spreads we ever saw in terms of negative sentiment. We talked back then about how that increases the odds the S&P would have a good return going forward. That's exactly what's happened. But now we have the S&P 500 27% higher. And you would think this is the way, this is counterintuitive. It's to me, you would think people would be less bullish, but they're much more bullish with higher prices. So S&P 500 below 3,500 last October, and you have way more bears than bulls. And today S&P 500 is all the way up at 4,400, and you have way more bulls than bears. So opposite sentiment in terms of the equity market versus shoppers. So if you think about Black Friday after Thanksgiving, you have these huge discounts and you see these people rushing to the stores, fighting each other to get these discounts for TVs and other items. And the equity market is the exact opposite. People, when they see prices go up, they're very happy. When they see prices go down like they did last October, using that shopping analogy, they're running for the exits. And so very interesting to see that sentiment has flipped on a dime here. I wouldn't say necessarily it's extreme, and you don't get the same signal in terms of high levels of bullishness versus high levels of bearishness, but something to watch here. For sure, that wall of worry that we had for much of this move higher is now gone, I would say. So that's one positive factor that is taken away. So from here, it's going to be much more difficult, I think, to show a significant advance because you have so many more people in the bullish camp. So if we dig into why people are positive and you rank the reasons, I think number one would be inflation and Federal Reserve policy, probably tied for number one. And finally, at long last, people have been waiting for this. We've been talking about it and saying that they had all the data that they needed to pause, but the Fed indeed paused this week on their interest rates, keeping them at 5 to 5.25%. And was this a surprise? No, absolutely not. As I've done before every single meeting, the day before, what I do is tweet out tomorrow's news today. And so I pretty much said the Fed's going to pause after 10 straight hikes, holding interest rates. How did I know that? No, I don't have inside information from the Fed. I don't have a crystal ball. All I do is look at Fed fund futures. And if the day before they're showing the high probability of a hike, I say the Fed's going to hike. If it's showing high probability of a cut, Fed's going to cut. If it's high probability of no change, the Fed has historically not changed. So since 2009, every single meeting, the Fed has done exactly what the market has expected it to do, and this time was no different, not hiking rates. But all of the attention wasn't on that. I think most people kind of thought this was going to happen, that the Fed would pause. It was really on the Fed's forward projections, and particularly their projections for the Fed funds rate. So every quarter, the Fed does these forecasts for inflation, for unemployment, and for their policy rate. And what they said in this latest meeting was that the year-end 2023 median expectation from these Fed members was 5.6%. So that was a jump up. We're talking about 50 basis point jump. That means that the median expectation from the Fed now is for two more interest rate hikes this year. So very interesting to see the Fed pausing here, but also saying we're not done yet. We're going to hike a few more times. But what I would say with these types of projections is throw them out. The Fed is consistently wrong in terms of estimating rates of inflation. They're consistently wrong in terms of estimating economic growth and unemployment and their own policy rates. So don't put too much weight into it. Jerome Powell actually admitted to this, saying that the Fed's projections over the long run are not very accurate in terms of what they're going to do. And all of this is subject to change. So if we see inflation data come in much lower than expected, you'll probably see the Fed back off of these expectations. If you see recessionary data really build up, or weakness in the jobs market, you'll probably see them back off this. And if we see all of a sudden inflation go the opposite direction and start marching higher again, perhaps you'll even see them lift these expectations. And as you can see here, the Fed has consistently underestimated in this cycle the rate of inflation and how long I think it would stay elevated above that 2% target. And you can see that because they've had to raise it almost every time here. They started in March 2021. So this is during the early stages of when we were seeing some evidence of increased inflation. The Fed was saying, no, we're not going to hike rates at all. We're going to have rates still at zero by the end of 2023. But gradually here, they're starting to change those expectations. And they, even when they started hiking rates in March 2022, they were only projecting 2.8% by the end of 2023. And now you can see those expectations have been lifted to 5.6%. So Fed's not very good at forecasting, just like anyone else, which is why my belief, which is not going to happen, is that we shouldn't have these small group of people, these Fed voting members, sitting in a room determining interest rates. We should let the market be determining interest rates, and not these people that are reactive and not proactive in terms of their policy actions. But in terms of where the Fed is now, in terms of are they tight in their policy, or are they easy in their policy? Well, the history over the last decade has been almost always easy in their policy. And finally, now we're shifting to a more tight monetary policy regime. And how do I look at that? Well, I like to compare the Fed funds rate versus the rate of inflation. And now we have a Fed funds rate that's over 1% higher than CPI. So CPI dropped to 4%. You have a Fed funds rate over 5%. So more than a 1% spread. And that's been an unusual thing if we look back the last decade. We haven't seen the Fed be above zero, so have a policy rate above that 0 to 0.25% range, and have a Fed funds rate that's 1% above the rate of inflation. We haven't seen that this entire period here. You have to go all the way back to October 2007 to find that situation where the Fed is above zero in terms of their policy rate, and with a Fed funds rate 1% or higher above the rate of inflation. Now, that doesn't mean that all of a sudden the markets have to crash like they did after October 2007. Every time is different. You can have a period like we did during the 2000s leading up to the October 2007, where you had a long period here where the Fed funds rate is above CPI. So we don't know. Perhaps we're going to transition to more of a normal type of monetary policy environment, where for years after the financial crisis, the Fed did the opposite. They chose to keep rates at zero, even though the economy was out of a recession and in an expansion, and they chose to keep that real Fed funds rate at a negative level. So they kept that Fed funds rate well below the rate of inflation for almost this entire period here. And perhaps now we're going to shift back to a normal regime where historically we've seen a Fed funds rate at least slightly above the rate of inflation. So that remains to be seen whether that's going to happen or not. But right now, we're finally in restrictive territory. And there's the saying, there's the long and variable lag to Fed policy. So if that's indeed the case, we're going to just start to see the impact from this tight policy in the coming months. We haven't seen it just yet because we haven't really had restrictive policy until just recently, where the Fed funds rate is above the rate of inflation. So what are those expectations for the market? So the Fed is predicting two more rate hikes this year. But as we said, the Fed can change their mind all the time, and as does the market. But the market is not so aggressive in terms of their expectations. The market's saying just one more hike, and that's going to happen in July. I'll tell you why in a little bit. I think that's a crazy assumption by the market that the Fed's unlikely to do that in July, but that's the expectation as of now. But interestingly, this entire curve has shifted significantly over the past few months. So a few months ago, after Silicon Valley Bank failure, and we had all this fear and concern in the market, market participants were saying the Fed was going to hike in September of this year. Not hike, cut in September of this year, of 2023, and keep cutting rates to below 3% by the end of 2024. Now they're saying the Fed's not going to start cutting rates until January 2024, and that terminal rate at the end of 2024 is going to be much higher at around 375. So big shift in expectation. And what's driving that? Well, the primarily less concern about the U.S. economy, strong jobs numbers, and rhetoric from the Fed continues to be that they're saying rates are going to be higher for longer. And I guess the market initially was not believing that, but I guess there's now more and more starting to believe that the Fed, if you listen to Powell, seems to be saying we're going to need to have that higher rate of from a Fed funds rate to really break core inflation and bring it down. So we'll see. This is all subject to change, but interesting that the expectations have shifted this much in a very short period of time. So what's that doing to the Treasury market in terms of yields? Well, now we have 1-year Treasury yields highest since 2006. So completely recovering from, again, that post Silicon Valley Bank reaction, which saw yields really plummet on the expectation that the Fed was going to start cutting rates aggressively by September and continue to cut rates thereafter. Now the market expectations are pushed back, and you're seeing the highest 1-year Treasury yields since July 2006. So savers rejoicing. You're going to get this risk-free rate is going to continue for a bit longer here. You can still get over 5% on money market funds, online savings accounts, and all the rest of it, as long as the Fed is maintaining that policy rate above 5%. So if we look at the Fed and we compare it to other central banks around the world, we're seeing a very different picture today than a year ago. So a year ago, the Fed, the ECB, Bank of Australia, Canada, all of these developed world countries were far behind the curve. You had many emerging market countries started hiking rates earlier. All of the countries I just mentioned were very late in terms of starting their rate hikes. And today, we're just starting to see restrictive policy from the U.S., but a number of emerging market countries are seeing policies that have been restrictive for some time, and perhaps maybe getting closer to a level where they can start cutting rates. So if you look at some country like Brazil here, with a target rate well above the rate of inflation under 4%, they have a central bank rate 13.75%. Well, they're in a position now to cut rates. If we look at Mexico, probably similar situation. If we look at India, we have a central bank rate over 2% above the rate of inflation. And interestingly, China, which has a very low inflation rate now, people are saying that you're seeing an economic contraction there, perhaps. You can't trust really any of the data from China, in my opinion. But interesting thing is that people are talking about the Bank of China cutting rates at their next meeting. So we're starting to see a shift, more chatter in terms of perhaps this trend where everyone was hiking, bringing rates up to fight inflation. Perhaps we're going to see a more bifurcated market where countries are starting to cut rates. The U.S. obviously isn't there quite yet, but these countries that hiked rates earlier than the U.S., countries like Brazil, perhaps you're going to start to see them cut rates. And then you also have countries that are still behind the curve. So if we look at the UK, if we look at the Bank of England, they're saying they're going to continue to hike rates. They still have an inflation rate much higher than their central bank rate. They're probably going to go over 5%. The ECB did hike rates again this week, but there's probably more to go there. Still have a negative real Fed funds rate. And so a number of these countries perhaps are going to continue to hike, But if we look at the US right now, we're on pause. And why is the Fed pausing rates? Well, all of the data on inflation has been trending in a positive direction. And the news we got this week, a day before the Fed meeting, very positive, and it was an upside surprise in terms of what people were expecting going into it. So I do this poll before every inflation report. The consensus estimate for CPI was 4.1%, and most people thought it's either going to be above it or at it, and we actually got a print below it. So we got a 4% number for overall CPI, and a number of the readings were moving lower. This is the 11th consecutive year over year decline in terms of CPI moving lower. So we peaked last June, 9.1%. And in each and every month since then, we've seen a lower rate of inflation. Now, this doesn't mean that prices have gone down overall. Unfortunately, prices have not gone down overall since then. They're still up 4% over the last year. But this is a good start in terms of the rate inflation going down. And importantly, we're starting to see signs that core inflation perhaps is going to start moving down in a more meaningful way. Did tick down to 5.3%. And if we dig into the some of the components for this, if we look at the year over year rate of change for the biggest components of CPI, we have most of them at a lower rate of inflation than where they were last June when CPI peaked at 9.1%. Only shelter, food away from home, and transportation are higher, showing higher rates of inflation than they were last June. Everything else moving lower, and many of the categories much lower. So just a complete reversal in the commodities areas. We look at fuel oil, gasoline, utilities. We look at natural gas prices just collapsed. We're seeing outright declines on a year-over-year basis. Used cars continue to decline on a year-over-year basis. But areas like new cars finally starting to see much lower rates of inflation. And really important one here, food at home, under 6%. We talked about that. Looking at fertilizer prices, I think there's more to go there. And I think you're going to see this continue to come down. So why is shelter still showing elevated here at 8%? And why is shelter so important? Well, put simply, people spend more money on housing than anything else. It's over a third of CPI. And shelter, as we've talked about every single month, shelter's a lagging indicator. It's not showing real-time data. It's not looking at real-time home prices or real-time rents. It's showing a lagging picture of that. And the real-time data continues to trend down. So if we look at U.S. rents, so data from Apartment List, we're at less than 1% in terms of the increase on a year-over-year basis, and I think this is likely to go negative. The Redfin data is already negative on a year-over-year basis in terms of asking rents. And if we look at shelter CPI, it finally peaked 2 months ago at 8.2%. Last month, it showed 8.1%, and now we're down to 8%. So I think this trend will likely continue. Again, it's reflecting the data from rents and home prices just with a lag. So finally, I think we're going to start to see a more meaningful shift there. And when that starts to move lower on a year-over-year basis, given its big weighting, we can see a meaningful impact on overall CPI. But in terms of actual shelter CPI, looking at the level, perhaps there's more to go. Even though the rate of change is likely to come down, you could still see increases in that shelter CPI. And that's simply because it hasn't closed the gap with the actual data. So actual rents are up 22.6% since the start of 2020. Home prices are actually up 40% since the start of 2020, while shelter CPI is only showing a 17.5% increase. So wildly understating the rate of housing inflation in 2021 and 2022, and now playing catch up, while those factors, those rates of inflation on the actual data, if we look at home prices or rents, they're probably both down on a year-over-year basis, and shelter is catching up with that data. So if we look at food prices, this is something we talked about. Looking at wholesale egg prices had absolutely collapsed, but with a lag, you see lower retail prices at the store. We're seeing that with the average price of an egg now down, a dozen eggs down 45% from its peak in January. So we peaked at $4.82 for a dozen eggs. We're down to $2.67. I think next month this will show an even lower price for eggs. So great news for consumers across the board with lower food price inflation. And finally, as we talked about last week, but we said this is likely to happen, but it has finally happened. We're in positive territory now in terms of comparing wages to inflation. So wages have outpaced inflation now on a year-over-year basis for the first time since March 2021. So 25 consecutive months we had where inflation was outpacing wages. Is a big reason why, even though we weren't in an official economic recession, it felt like a recession for a lot of people because their purchasing power was being eroded with inflation. And as I've said many times, and I'll say it again, the path to prosperity for the US and for any country is to have positive real wage growth. So hopefully this is a trend that is going to continue. And I think it will for at least another month. And the reason for that is next month we're going to get an even better inflation print because the June number from last year is going to drop off. And that was a huge number. It showed a monthly increase last June, so June of 2022, of 1.2%. And so that number's gone. It's going to be replaced by a much lower number. We don't know exactly what it's going to be, but assume it's going to be anywhere from 0.1% to 0.4%. That seems to be a reasonable expectation. Well, that's going to bring CPI down to low 3% area. So 3.2% is the expectation from the Cleveland Fed. I think that's a reasonable expectation. So we're going to see another positive month for real wage growth. So very good sign there. And if we look at Trueflation, their real-time inflation gauge, so real-time year over year, what they're saying now is we're down to 2.4% from a peak of 12% last June. So very different picture here in terms of inflation measures, everything trending in a positive direction, which is why I think the market's a little bit ahead of itself in saying that the Fed is likely, after pausing this week, they're going to hike rates at the end of July, 74% probability here. I can't see the Fed having any real urgency to do that, given the real-time inflation data, given that the CPI is going to go down to 3.2%. If they were comfortable pausing at 4%, why would they hike at 3.2%? It doesn't mean that they can't do it. It just, in my mind, is a little bit unlikely. I think these expectations are going to change as we get closer. Obviously, we're going to have additional data points. We have PCE for this month coming out. We're going to have that CPI report next month, which we expect to drop. But if there's a surprise there, we're going to have another employment report that the Fed will obviously be looking at as well. But I think the market here is a little bit aggressive in saying that the Fed is going to see some type of urgency to hike interest rates when they meet in July. I just don't see it based on the current data. So other areas in terms of inflation that are trending in the right direction, if we look at PPI down to 1% year over year, that's the lowest since December 2020. I think we're likely to see this go negative. A big driver of producer prices, obviously commodities and input costs. I think that you could very well see that go negative next month or close to it. And that's another reason why I would say at the Fed, are they really going to be pushed to hike rates if you have a negative PPI and you have a CPI down in the low 3% area? Now, important point on inflation, and this is a question I get from a lot of people, and it's a valid one. Just because inflation rate is going down, it doesn't erase those prior price increases. So to give an illustration of this, I do this every month, but just an update of this, the past 3 years, U.S. wages have increased 12.5%. Pretty good, great sign that wages are going up. The problem, of course, is that prices in many areas are going up or have gone up much more. So if we look at food, obviously being a big one, 19% increase. If you look at gas prices, significantly higher. Of course, this is comparing to 2020 levels, but still significantly higher. If we look at rents, 22% higher, home prices, 38% higher. So this is the big reason why people are fearful of inflation, and it's had the impact that it's had. It's because wages haven't been keeping pace with those overall price increases. But again, hopefully we're going to shift now in the other direction, where even if these prices don't come down, and they have on the energy side, we're seeing lower gas prices, fuel oil prices, used cars come down a little bit. home prices come down a little bit. But even if they flatline and you let wages catch up to that, well, people will be feeling much better about that. But I think certainly this is something that can't be ignored. The fact that, yes, the rate of inflation is slowing, but actual nominal prices are not going down overall, not going down just yet. So let's shift gears here to talk about an interesting topic. And this is one that I often get whenever I tweet anything about or mention anything about buy and hold or being an investor in the long run and investing, really investing with the belief that you're going to have a positive outcome if you invest over, let's say, a 20-year period. Everyone always says, what about Japan? There's always the people that are looking for a hole in the thesis. And Japan's a very interesting animal here. If we look at the Japanese stock market from 1980 to 1989, you had this enormous run up. It was a bubble of epic proportions. You had the Nikkei index up 492% on a price basis. So that doesn't include dividends. Just a huge, massive run up higher. Valuations were at extremes, and I'll show that in a little bit. But over the next 10 years, not so much. You saw the opposite. Nikkei is down over 50% 10 years later, and it would go on to even at 2009 when it finally hit its low. I think it was down over 80% from that peak. So what happened with Japan? Why is Japan such a problem? From its peak in December 1989, well, valuations just got crazy. It was just an absolute mania of epic proportions. If we look at the CAPE ratio, which is simply smoothing earnings over a 10-year period and taking a current price, you had a CAPE ratio of Japan in the high 70s area. So in comparison, the U.S. equity market bubble in 2000 peaked with a CAPE ratio in the mid 40s area. You had the Japanese stock market significantly higher. So just a huge bubble. And from there, as I've said, Japanese stocks would go down 82% from that peak to its low in 2009. So just a huge long period of absolutely no returns. And now finally, the Nikkei index is getting close to those highest levels since March 1990. But going back to that original thing, that statement that people make now, they say, now show Japan, or what about Japan, as kind of the counter argument to investing works. They say, well, had you been an investor in Japan, well, it wouldn't have worked. And what I would say to that is that you shouldn't have all of your money in one area of the market. And anyone who is investing in Japan should have taken a global approach. And particularly during a bubble, the best thing you can do is diversify away from that bubble. So had Japanese investors invested outside of Japan in 1990, they would have done extremely well. The U.S. stock market has advanced 2,400% since the Nikkei peaked in early 1990, late 1989. That's over 10% return per year since that point in time. So not a bad return. And if you were a Japanese investor and had a lump sum 100% in Japan during this period of time, yes, it would have been an extremely difficult time period. But even for a Japanese investor who didn't diversify, didn't believe in spreading their risk across different asset classes and different markets, if they were not doing a lump sum but just dollar cost averaging into the Nikkei, would have been a very difficult period here. But at this point, their return would have been much better than what this buy and hold with a lump sum in late 1989 would have been. So that's not to say that anyone should do that. They shouldn't. You should diversify globally. But if someone were to start investing in 1990, let's say, and add money every year into this Nikkei index, well, if you look at today, they probably would have a return somewhere, I'm guessing, in the mid-single digits total return, including dividends. So I'll do that calculation and bring that back to you next week. But an important point for investors: if you see an equity bubble, you see a mania. If we even look at the U.S. in March 2000, the answer is not to say don't invest at all. The answer is to say, I'm going to still invest, but I'm going to be more diversified, ideally in areas that are not in a similar bubble. So if we look at Japan in 1989, the US stock market, in terms of its CAPE ratio, was well below 20, so not at any valuation extreme. Obviously, in 2000, both of these countries were at extremes, but there were areas that weren't at extremes in 2000. If we look at the US small cap market, if we looked at other countries around the world, they would have fared much better from 2000 to 2010. So uh, again, I think it's kind of a straw man argument when people say, uh, look at Japan as a reason not to invest, because they're arguing a point that I'm not making. I'm not making that the point that stocks always go up or markets only always go up, and over long periods of time, you can certainly see markets not hit new highs. But the argument I'm making is that a diversified portfolio gives you the highest odds of achieving a positive return. And the answer to the what about Japan question is not to not invest at all. It's just to look to become more diversified when you have an asset class that's clearly in a bubble like Japan was at that point in time. So let's talk about the US consumer really quickly here. More signs the consumer is pulling back. We've been talking about retail sales now for quite some time, and the year-over-year increase on a nominal basis still positive, still up 70 basis points over the last year. But if you adjust for inflation, and you have to adjust for inflation, this is very important, particularly when inflation's high, and it's come down, but it's still been elevated over the last year. It's down 3.3%. And so 7 consecutive year-over-year declines for this real retail sales. So inflation adjusted, we haven't seen a streak that long since 2009. So if you're looking for an indicator that's suggesting the economy could weaken from here, this would be the number one thing that I would be looking at. And if we look at consumer data, there's a poll put out here by CNBC. 92% of Americans are saying they're pulling back on spending, and they're doing it in areas where they're considering it, saying it's non-essential. So clothing was one example they gave. They talked about forms of entertainment, big ticket items, certainly Home Depot. We've talked about people are doing less projects there. So the consumer is pulling back. And if we look at retailers, they're starting to look ahead to the holiday season. It's still a little bit early here, but if you look at what they're saying, at least now they're saying they're ordering less than they did a year ago in preparation for what they believe to be a slower holiday season. We'll see if they continue with that belief or not, but there's no question the US consumer is slowing down. And the driving force for that has simply been higher interest rates. So it's harder to finance goods. Your credit card bills are going to be higher. It's harder to get a loan in terms of auto loans or big ticket items. Anything that has to be financed, much more difficult today than a year ago. And the other driver is simply the built up savings that people had from the stimulus are starting to wear out. And there's some estimates saying there's a few hundred billion of that left, which is still, I would say, a meaningful number, but certainly less of a factor than it has been if we're looking back a year ago. So a number of things driving for that, but as long as employment is there, as long as people have their jobs, and if inflation is going to come down and stay down, that's going to change this picture in a more positive direction. So it's difficult to say if this trend will continue here, but certainly here and now, right now, it seems like the U.S. consumer is pulling back. The question is, how long is it going to last? So I want to end, as I always do, on a positive note and looking at teenagers and the jobs market. And it's pretty good time to be a teenager looking for a job this summer. If we look at the hourly wages for 15 to 9-year-olds, this one it shocked me here. Almost $15 an hour, which would have been unheard of a few years ago. You have this hourly wage up over 40% since the beginning of 2020. And I read a few things, a few articles looking up for the reasons for this. And I guess it's just simply supply and demand. And now there's still demand for workers and the type of jobs that teenagers do. It's driving up wages for them. So a good sign if you're a teenager looking for a job this summer, you're going to get paid pretty nicely. And the money that you earn is going to go much further in terms of if you're driving around this year versus last year. What a difference in terms of gas prices. Now we're around 3.50 a gallon. Remember, this time last year, gas prices were peaking at over $5 a gallon nationally. So a big decline. And that's why when we get that June CPI report in July, you're going to see those massive year-over-year declines for gas prices and utilities, and almost all commodities have a significant impact on that. So good inflation trends, Fed pausing, markets running higher, a lot to be excited about. Keep that sentiment in check. As always, you want to be more bullish when stocks are going down, not up. Try to think counter to the way most people think. But good news here for inflation, and hopefully that continues. So with that, we'll end it right there. Thanks everyone for joining me. Have a great weekend. Happy Father's Day to all the fathers out there, and I'll see you next week. Thanks.